I want to spend a little bit of time today just talking about the offensive and defensive characteristics of the healthcare sector, what we think the longer-term secular growth opportunity is within the space, as many clients today are beginning to view the healthcare sector as a really attractive longer-term secular growth allocation within a broader equity exposure. So when we look at the overall breakdown of the portfolio today, or the conversation today, excuse me, we'll discuss the offensive and defensive nature of the sector, what the opportunity is, and why we think that focusing on businesses rather than science when investing in the healthcare sector makes a lot more sense for clients in delivering better risk-adjusted returns over time. So I think what most people tend to think about is within the healthcare space, people tend to know the characteristics as traditionally defensive, right? Inelastic demand. Typically, when markets go down, healthcare tends to be resilient. But what I think people tend to overlook is the offensive characteristics associated with the space. So looking on the left-hand display here, the 10 years ended December of 2022, healthcare was the second best performing sector in the MSCI world more broadly, second only to technology. So outperforming the MSCI world by about 300 basis points on an annualized basis over the last decade, and looking back over the last 15 years, outperforming by almost 400 basis points on an annualized basis. So very strong relative performance versus the broader market, which I think many people tend to think is kind of counterintuitive for a traditionally defensive sector. When you look at healthcare, though, it's not to say that by taking on that offensive exposure that you've had to forego the defense. And when we look back to the last 20 years, 20 plus years, what you have seen is really consistent downside mitigation in every down market for the broader MSCI world. So what has driven that evolution or that newfound kind of offensive characteristic within the space? It's really been the evolution of the sector. Looking back to 2000, about 80% of the MSCI World Healthcare Index was broken down into pharmaceuticals. Fast forward 10 years, that number went from 80% to about 60%. Fast forward to today, and that number is now about 40%. So what's taken up the bulk of the sector? What you tend to see there is things like healthcare equipment and supplies, managed care, biotechnology, healthcare technology, for instance, life science tools and equipment. So all areas where there is a tremendous opportunity for innovation that can help to drive longer-term growth. So what's the opportunity? First and foremost, we're all getting older, right? The idea that by the year 2050, the population of people over the age of 65 is going to double to more than 1.5 billion people in the world. That's a huge number, and as we get older, typically people have to go to the doctor more regularly. You must undergo, unfortunately, more surgical procedures, so your average person has 6 to 7 surgical procedures in their lifetime. We have to take more medication. And what also has to happen is we have to bring costs down for the broader system, and we need to make the system more efficient. So all of those problems really invite innovative and differentiated solutions to achieving them. So the big question mark is kind of this constant tension. You think about innovation, the need to develop new drugs, the need to develop new medical devices, new equipment to help us better live our lives in a healthy way, the need to find more efficient ways to use what is a wealth of data. The question comes down to what do you as the patient pay for that innovation, and ultimately what does the regulatory burden around the healthcare sector look like? So this constant tension across these three factors, we think, creates a lot of opportunity for active management to add value within healthcare over time. The bigger question, though, is how do you best approach an investment within the healthcare space? Many people tend to focus on trying to predict scientific success. In our view, that's not the best approach. So what we tend to do is we tend to focus on the underlying merits of the business. So why don't we focus on scientific success? When you look on the left-hand display here, we're looking at the overall success rates from phase 1 clinical trials to approval at different stages. And on the right-hand side of the page, you'll see from going from phase 1 to approval, what's your ultimate success rate? 8%. So said another way, it's a 92% failure rate for a drug to make it from stage 1 to the market. So how can we as investors tell you as our potential clients that we know the science better than the scientists who are doing all the work to try and bring these drugs to market to begin with? It's very, very challenging and tends to invite a lot of volatility to the overall client experience. So what we look for instead are really durable business models. We'll talk about this more in a second, but really durable business models because they tend to deliver a more consistent risk-adjusted performance. If I were to take a show of hands here of basically who would think that biotech would have outperformed United Health over the course of the last 10, 15 years, most people would have said, I'm sure, biotechnology, because that's where the innovation is. That's where the growth is. Those businesses should outperform over time. When you actually look at the display, the United Health, which is a managed care insurance company in the US, it's outperformed the small and mid-cap biotech index by 16% annualized with 10% lower volatility. So just because you're taking on a more defensive and more productive business, it's not as exciting as you might see within the biotech space, doesn't mean you have to forego returns over the longer term. So our approach is a broad healthcare approach. This is not a single themed approach to investing within the healthcare sector. We are benchmarked to the MSCI World Healthcare Index. We're 5-star rated by Morningstar. When we look at the overall level of concentration, you are seeing a 40 to 60 stock portfolio, so very compact. You can think about this as really being high conviction and being fundamentally driven. We want to take larger bets in stocks that we have really attractive longer-term fundamental analysis on. This is the sweet spot for us. We can properly express our conviction in stocks that we like, and then also we're diversified enough where we're not necessarily taking on a tremendous amount of single stock risk. What I think is really important to note is the right-hand side of the display. So when you look at the calendar year rankings versus the peer group more broadly, what you'll notice is that this portfolio has not delivered a very volatile pattern of performance versus the peer group. In good years, we're not first percentile. In bad years, we're not 100th percentile. Instead, what we believe is that if we can deliver in our best years a top quartile, top third-like performance, but in our worst years, roughly perform in line with the median, what you've then seen is in the middle display. On an annualized basis, going back to when the team took over the strategy a decade ago, you've had top decile performance and in most cases top 5% of the peer group more broadly. So very consistent pattern of performance. So what do we look for? We're looking for high quality business models that have a high level of profitability, specifically measured by returns on assets and return on invested capital, but then have ample opportunity to reinvest those profits back into the business above the company's own cost of capital. If you can do that, you can self-sustain your longer-term growth aspirations, and that allows you to deliver more consistent fundamental performance, and as a result, more consistent risk-adjusted performance for clients over time. So when we think about this is a little bit small, so I apologize, I'll explain it. When we think about the overall construction of the portfolio and what kind of businesses we're looking for, we really like to identify companies that we call operate in a virtuous ecosystem. So first and foremost, is the product or service that you're producing lead to a better outcome for the patient? I think that should be a given for most people when investing within healthcare. But also, we want to find companies that product or service is also helping to reduce the cost for the patient and is helping to reduce the cost for the healthcare system more broadly. And of course, these are businesses. These must be profitable for the company to make. So if you can tick all three of those boxes, we believe that you're able to better compound your fundamental performance over time. So when we look at the overall characteristics of this portfolio versus the peer group and the benchmark, you'll notice some, I think, pretty unique characteristics here. So the zero line is the MSCI World Healthcare Benchmark. The different colored rectangles are the different quartiles of the Morningstar Healthcare Peer Group. If you have a greater than zero exposure, it means you have a higher exposure to that factor than the benchmark. And if you are less than zero, you're underexposed versus the benchmark. How you then plot on the chart is how you rank versus your peers. So given our focus on businesses first, what you'll see on the far left-hand side is that we top the entire peer group with regards to profitability as measured by returns on assets. We are also well above that of the benchmark. Importantly, the stability of the company's growth is very high because it's self-funded. What you'll then see, though, on the far right-hand side is that by taking on that factor exposure, taking on that profitability and that stability, What you then tend to trade off instead is we don't take on a lot of volatility, we don't take on a lot of beta or a lot of momentum exposure. That's really different from most of the other managers in this space, where you'll notice the purple, the teal, the yellow, all tends to be well below that of the benchmark. That tends to be well below most of the peer group. And that's because these companies or these managers are typically looking to take on a lot of smaller mid-cap biotech, looking to try and take on the risk that we can call the drug trials correctly, that we can deliver on that innovation. In our view, this is a much more differentiated approach to investing within the space. One other thing that we look to do is bring a really keen focus on risk management. So what you will not see here is a really diversified portfolio with a lot of factor or country risk in it. Instead, what you'll notice is that about 80% of the risk of the overall portfolio is derived from stock selection. So coming back to that 40 to 60 stock portfolio where we can take high conviction bets in stocks that we think are fundamentally attractive. We've got de minimis exposure to country, de minimis exposure to sub-industries. And what that's led to, going back over time, we talked about the pure returns before, but looking at returns and risk-adjusted performance, whether that's Sharpe ratio or information ratio, over the last 1 year, 3 year, 5 years, 10 years, you'll notice that in every single time period, it's top decile versus the broader peer group, in some cases, top 1% of the peer group more broadly. So really good risk-adjusted returns. And importantly as well, a much smoother pattern of performance. So when you look at the up and down capture versus the median healthcare manager, what you've seen is that we've captured more than 100% of the market's upside when the healthcare market is going up. But importantly, when the healthcare market comes under pressure, we provide that downside mitigation compared to the broader peer group. So top decile in terms of both up and down capture. So you can think about that as being a function of two things. One, it's the types of companies we invest in. So if you have a high level of profitability and a good balance sheet, you should provide more resilience in difficult markets. But the reinvestment opportunity that we're looking for helps to drive that up-market participation. The other component is that active risk management that we've talked about just thus far. So just to recap, why do we think that the healthcare sector is really interesting? Demographics are changing. There's a tremendous amount of need to make the system more efficient. There are a ton of different diseases that we still don't have cures for. Think about the common cold. We still don't have a way of properly curing the common cold. So there's a lot of inefficiency within this space that we think will drive consistent innovation, but because of the inelasticity of demand, the need for us as people to access the healthcare system, the need for us to access the system without delay, we think that really helps to drive really consistent fundamental performance for many of these businesses and helps to provide that resilience, that downside mitigation. So with that, I've got about 2 minutes left. I'm happy to take any questions if there are any. Okay. Yes, please. It's been a frustrating year for the healthcare sector this year. My predecessor on the stage was talking about AI, which has been a big driver of market performance. One thing that's been kind of a notable laggard is the AI kind of trade within healthcare, which we think is a really attractive longer-term opportunity for those companies who can harness it properly. One of the challenges has been that as all things tech and risk on have gone up, we've had a pretty significant sell-off in some of the healthcare sectors in the portfolio or in the market more broadly. So it's not to say that we don't think the space is attractive. We're looking at MSCI World Healthcare. It's down a couple % on the year with the market up. We think that there's a pretty significant opportunity to step in as liquidity providers to the market where fundamentals are still good and valuations have become more interesting, where we think things haven't really changed. Right? A lot of investors have just kind of looked to go risk on in this environment to take on some of the guaranteed growth trade associated with AI. When we think about opportunities within AI in the healthcare space, it's things like robotics, it's things like data management and efficiency, clinical trial management, all things that are really interesting. What we've seen most recently in earnings season is that good earnings reports were not rewarded and bad earnings reports were punished really badly, right? So the overall growth profile of the portfolio remains really strong versus the healthcare sector more broadly. Valuation is at a slight premium, which we would expect because the types of companies we look to invest in should trade at a premium. But the expectation, look, is that the economy is going to continue to slow as the Fed and other central banks keep rates higher for longer given persistent inflationary pressures. that's going to create an additional slowing effect on the broader economy, and that will create more market volatility. In that environment, those companies that can deliver more consistent levels of growth should be rewarded, and the defensive characteristics that people tend to look for in periods of abnormal market volatility should also help to provide some fundamental support for those investors with an allocation. So we still are really optimistic about the opportunity within the space, but expect that it's very likely that we just see more volatility in the near to medium term as we work through this kind of slowing period for the market more broadly. Thank you. Any other questions? Okay. Well, thank you very much for the time today. Enjoy the rest of the day. Thank you.